Good morning, everybody. Welcome to the Flow Show. Over one hump into another one. Morning, Stel. Morning, Kay.
Good morning. What do you want? I'm kidding. Good morning. Hello.
Yeah, wake you up again.
Hello.
Are you doing all right?
Good morning, everybody.
Not bad. I'm looking forward to the final. It's going to be a great game.
Yeah.
No, that's not today, huh, still. You still have
No. I know. It's Sunday, right? Yeah.
Planning ahead. Yeah.
How are you, Ryan?
Yeah, I'm all right. Disappointed to see France going through, but they put up a stiff fight, Morocco, but it wasn't enough in the end, was it?
Yeah, I was very impressed with the way they played. You know, people have compared them to 2004 in Greece. They have nothing in common with that team. They play nice attacking football. They run. I mean, I really enjoyed watching them.
Yeah, same here. It was as much as I got to watch it with everything going on last night with the PAL and stuff. But yeah, should be a good final. Can Messi lift his first World Cup? Probably his last chance, I think. So
Yep.
We shall see.
Yeah.
Right, so lots to go over today, and lots happening today as well. So I'll try and get through the headlines and stuff pretty quickly. Report out from a Hong Kong study said that China's death toll could top 2 million over COVID. There's been a lot of stories coming out from China about this big wave of cases coming in. Hospitals are under huge strains with these cases. Even nurses and doctors are having to work even if they catch COVID. So it seems like the floodgates are really open over there, and it's becoming quite a changing situation to what it was a few weeks ago with this reopening stuff. It is twofold. There might be a huge health impact here, of course, but if it does follow what has happened elsewhere, then people are going to get sick for a week or so and then hopefully recover and get on with their lives, and much like we do over here now in other countries. But I think this initial wave is potentially going to be huge if it isn't already. So need to keep an eye on that and what officials do with that over there. Over to Japan, and a money manager at a big Asia fund, PineBridge Investments, was out with a piece in I think it was Bloomberg, saying that the mother all pivots in 2023 could be the yen and the Bank of Japan tweaking policy. And that the pivot risk is rising with the reports of the Bank of Japan potentially looking at their monetary policy framework. So he's suggesting that the yen could be the favoured trade for next year. As you will well know, it's something we've been talking about in great detail. Reuters did a little ring around their economists and analysts for the Bank of Japan next week, and the consensus is they're going to keep to their ultra low rate policy, but will hold fire until the global outlook becomes clearer. They're always waiting for something to become clearer, probably why they've never done anything for the last 15 years or whatever. Anyway, that's analyst thoughts pretty much for Bank of Japan. Low expectations for next week, as we well know, which obviously puts the big price risk if they do actually tinker with something, a bit of language or anything like that. Following the Fed last night, Hong Kong Monetary Authority hiked 50 pips. So did the UAE straight after. So all those banks that keep in line pretty much with the Fed hiking as well by 50 pips. Coming over to Australia, and consumer inflation expectations took a little dip down to 5.2% versus a prior 6%. Quick look at some of the data while we're over in that side of the world. Trade balance data from Japan out. Exports and imports still running at hefty clips, big numbers here still, and that trade balance really flipping around. It's all over the place. A lot of it is obviously to do with what's happening in the currency as well, masking or making a difference between what inputs cost and what exports are sold for. So still numbers really moving around there quite significantly. Just heading back to China and some other stuff in Australia as well. Employment numbers from Australia looking pretty good, 64K employment. The participation rate rose to 66.8, but the unemployment rate stayed as it is. So that's pretty good numbers there as well when you mark the two together. In China, we had some other data as well. Industrial production, a little softer than expected, but still positive. Some of the numbers there. Retail sales, not really surprising, taking a little bit of a battering there, given all the lockdown stuff that's been going on over there as well. The central banks haven't stopped coming. The SNB raised by 50 pips, as was widely expected. Blew our expectations for maybe going to 75 out the window. I did trade dollar Swiss going into it. I shorted at 92.69 just before the announcement and hit my get out button as quick as I could when it came up as 50 basis points. So I managed to get out for about 7-8 pips profit on that, but didn't go according to plan, and they only went the 50. Norges Bank as well, they hiked as expected 25 pips, their rate up to 2.75 now. Over in the UK, UK Chancellor Hunt is apparently looking at prolonging the energy aid that they've got in place for firms and businesses, and that's due, I believe, was due to run out in April. That's potentially going to get extended as well. And PM Sunak is apparently looking at introducing some anti-strike laws, given the level of strikes we've got in public services, trains, NHS staff now looking to strike, postal services on strike, plenty of others. So now he's looking to maybe bring in some laws to try and stop that.
Ryan, you know how do you know how people strike in Japan? I read it some time ago, and it really surprised me. They still go to work, but they kind of wear a sign that says "I'm on strike." I've actually read about that. I'm not joking, and it's like, you know, some positions, you just, you know, I see what's happening in the UK with rail and stuff, and everything just collapses, right? And yeah, you know, people have trouble getting to work and all that. It's crazy that these people can actually affect everybody's you know, day-to-day activities. But I guess they have their own rights, right? And they want to ensure they have you know, they're treated fairly, let's say. Anyway, it's interesting. Well, interesting about Japan.
Yeah, it doesn't surprise me they do something like that. But yeah, in the UK, I mean, you know, you only hear the tip of the iceberg, what's going on, and you know, we could spend hours in a pub talking about this. Just to give you some example, you know, most of the stuff you hear about is over working conditions, you know, taking people off of trains, guards and stuff, and just leaving the driver on, and hours work, that sort of thing. And that's all well and good. And, you know, a lot of people have a lot of sympathy for that. But when you hear that the unions are stopping people from sharing minibuses when they're going to work on the same job, so people who, let's say, are working on fixing the railways, fixing signal boxes or something, they won't let them, two lots of different people, share a van if they're going to the same job. They have to have separate vans according to the unions. So when you hear that sort of stuff,
wow,
why they're striking, you tend to think, you know, do me a favor, just get on with your bloody work and let the rest get on with it. But anyway, I say I could probably moan about that all day, and we don't want to bore people to death. And speaking of rules and regulations, the SEC is apparently going to bring or propose big changes to stock market trading rules. This has been going on bubbling under the surface since the GameStop stuff and all the Wall Street bets business. What they want to do is bring better competition on pricing for traders or for investors. So rather than a lot of these high-speed traders all getting in the decent prices, they want to open it up so that better pricing is given to investors. That is apparently going forward to a public discussion, which will happen between sometime in March next year before anything progresses further. Right, let's get into the Fed. And obviously, they went 50 pips last night. I'll go through a few of the main headlines from Powell that I think are relevant, and then we can talk it over. So from Powell, they said that they're yet to feel the full effects of tightening and have more work to do. Expect ongoing hikes are appropriate to get sufficiently restrictive. The US economy slowed significantly from last year, and a restrictive policy stance is probably needed for some time. On inflation, so far for October, November, it's been a welcome reduction in the monthly pace, but they need substantially more evidence of lower inflation, and that risks to inflation are still weighted to the upside. On hikes, there's still some way to go, and it's important that policy restraint is reflected in financial conditions. And as you know, we've been talking about financial conditions and that part of the Fed trade, if you like, and he mentioned it quite often yesterday. Again, repeated that they're not yet at sufficiently restrictive policy stance, but later then said that policy is getting close to sufficiently restrictive. They cannot say that the Fed won't move up the estimate of the peak rate at future meetings, but he also countered that in another answer, saying that they could also lower the peak rate if that's what they deemed necessary. And on what they did, it was important to move quickly on rates earlier this year, but it's not so important how fast we go, and says there are no rate cuts priced into the economic projections. I also said that he wouldn't see the US considering rate cuts until the FOMC is confident inflation is moving down in a sustained way. Pricing this morning, we're now pricing 25s and 50s, whereas pre-FOMC we're pricing 50s and 75s. And the probabilities currently at that are 73.5% for a 25 pip hike in Feb and 26.5% for a 50 pip hike in Feb. So the market has drawn down its rate expectations despite Powell sticking to the lines that the Fed ceiling is going to go higher. And that was obviously marked in the dots, and that they're going to keep rates up higher for longer. Now, I just want to show you quickly what happened in the dots, then I'll bring the other guys in, if I can find the bit. There we go. So just going to bring that in now. So this was September meeting, and we were looking at these dots here for next year. Were they going to move up above the 5% mark? And pretty much all bar two have done. So that was quite a significant shift up. I wasn't expecting perhaps to get that high, maybe get up somewhere between sort of 5 and 5.5, 5 1/4, 3/4 maybe, but it's gone. They've all shifted up. Also seen 2024 shift up as well, you know, some getting above the 5% mark. But what's significant here is that they really are spread out now. A lot of people, Fed members, go in around the 4, 4 1/4 area, but it's stretched out a bit, and that shows maybe a bit of indecision on what a lot of the members see coming for 2024. Now, you could say that's, you know, a year and a half away or whatever, but the short-termism of people's minds, some of this thinking here will probably be falling into what happens next year in 2023. So there's going to be a lot of trading between what the market sees happening here and what the market sees happening in 2024. And as mentioned, since we've had the Fed, and despite them shifting up their ceiling, the market is still in a position where it says, we don't think you're going to get as high as you think you are. And that's going to be the trade from here on out. As noted, yields need to be kept an eye on, and twos moved outside this rough rate ceiling box, if you like. We need to see if that gets maintained. I'm not too sure about thinking anything's going to be real in pricing between now and the end of the year, because it can get a little bit funky. But definitely going into the new year, I want to see where rates, what rates do there. If we stay below here, if we head down to 4%, that's the market further saying that the Fed aren't going to get up to their ceiling potentially. Right, we'll get into the prices as well, but I just want to get the lads' thoughts on last night. Who wants to go first?
I can go first, if Kate doesn't mind. So, my view on the Fed. Well, we did say that the most likely scenario was for Powell to disappoint, and if you look at the statement, okay, 50 was expected. That was never an issue. If you look at the statement, it was barely changed. So anyone who thought that the recent trend in CPI going lower would translate into something being expressed, let's say, in the statement, they didn't get that. So in that respect, it was a disappointment. But and then on the presser again, there wasn't anything particularly dovish about Powell. Now the interesting thing is that the way the markets are reacting is a bit strange, because we are seeing the expected risk off and dollar spike, dollar rally after that, but bonds are barely moving. So I guess the market is looking ahead, and they think that the pace of hikes is going to get reduced even further, so more 25s going forward, and the market's still pricing just under 5% as a terminal rate, and the dot plot, from what I saw, had slightly higher as a terminal rate. So overall, we're kind of, what the market's expecting and what the Fed are telling us are almost in line, but I still think the Fed is slightly more hawkish than the market expects. Now, this could all change, obviously. I think the next CPI print, the next couple of prints are going to be massively important. And I think the Fed is probably going to change, as I said, on the late first quarter 2023. I think they're going to change the tune quite drastically. But until then, the risk is still, I think, for equities to go lower, risk to get sold, not in a huge way, I don't think. But my takeaway from yesterday is that the Fed is not as dovish as the market expects, and that could continue for a little while longer. Just a little, not a lot, a little while longer. I don't know what Kay thinks, but that's my main takeaway, and we'll see how it goes.
Yeah, thanks, mate.
Hey, good morning, everybody. Morning, still, Ryan.
Mate.
I would like to start with something that Powell said, which goes against what I thought, is that the dots, okay, they might have been submitted before the CPI came out, but then he specifically said in the press conference that they can change the dots until the last minute. So that was something new to me, which points again at the fact that they are more hawkish than what the market is expecting. Because if they had the possibility, which we trust they had then, since Powell said it, if they had the possibility to change their dots after the CPI, they didn't, most likely, unless we would have seen more higher dots closer to or above 5, and then some exchange and lower, but at least the target rate was pretty close to expectations and slightly above 5%. So that was one thing that struck me. On the other hand, yeah, I agree. I mean, they just keep the line, right? Although he's going from meeting into meeting, he's going more data dependent. So yeah, I mean, the next CPI readings, the job report will be utmost important, of course. As for the market reaction, it's a bit like we said that could be the case, right? So you had the statement, the dots plot, the dot plots, dollars spiked just a little, and then once the market digested everything and the press started, the market reversed. And but now we are seeing a bit the opposite. And of course, we've got the rest of the central banks coming up, but it is a bit striking that after all, it seems like the market had to think twice or three times about what happened yesterday, and that now we are seeing the dollar a bit higher. If you look at stuff like dollar yen, for instance, I'm not going to talk too much about the euro and the cable, because we still got the ECB coming. But if you look at now that Norges Bank is over, dollar NOK is back into the 980s. It's dollar China for different reasons as well. But then stuff that was not really meant to correct a lot is as well. If you look at the Aussie dollar, the Kiwi, for instance. So the market is guessing, second guessing, third time guessing. I've got the impression that year-end flows we're waiting for the whole, or are waiting for the whole lot of the central banks to be done, and then we are going to see possibly a different move unfolding once more. But to me personally, I think the reaction this morning may be the more important one, if you see what I mean. Well, whatever happened yesterday was a lot of algos putting stops through left, right, and center in everything, and perhaps the real market will stand up only today and into the weekend, perhaps. So I'm as people in the room know, I've been and I'm still a little bit, but I'm long dollar China, long dollar Nokia. I think you can be. You have to be selective now what you do and which currency you pick against the dollar to be either long or short. There's a risk or a chance or a risk, I don't know how people would express that ECB goes a bit more hawkish today, in which case I think it's going to be more euro crosses. Euro dollar is going to be affected, of course, but euro crosses could be higher. And we are seeing like euro yen is higher, euro Kiwi, for instance, is higher. So yeah, it's a bit of a twofold thing, but we have to say that Powell did confirm the higher for longer, right? By saying it's not in the plans to cut rates. And as far as for the rate hikes go, I think they are going. I don't know whether the next one is going to be 50 or 25, but I think I'm going to err on the 25 side from now, because that's going to give them a bit of room to maneuver. Because if they go 50 from here, then they are getting extremely close to the 5% already. So I think from here, personally, I think it's going to be rather 25s than a 50 in there.
Yeah. Thanks, mate.
But I agree with that.
I'm still not a dollar seller based on the FOMC. Let's put it that way.
Yeah.
One more thing to remember: the next Fed meeting is two-day meeting is 31st January, 1st of February. So we have a month and a half until then, and a lot can happen until then.
Yeah, exactly. But I'm of a slightly different view on the dollar. I think the market reaction was very much as I expected it yesterday. Powell being hawkish or being unhawkish or not dovish, whatever you want to call it. I said the dollar and yields would be the upside is going to be the toughest path to take, and it was, and it ran into trouble and it reversed all the way down. It went exactly as I thought it would go, but this move this morning is surprising, and it is a lot of dollar involved in here. You do your usual checks, look around the crosses. You see dollar yen flying up. You look at the other yen crosses, and they're a mixed bag. So you tend to think it's not a yen side doing the job. Maybe thoughts about the Bank of Japan, but it doesn't seem like that. You look at yields, as shown here, the yields are looking a bit softer this morning. Not doing an awful lot, but we're not looking like we're getting back in the box and testing the post-Fed highs. Same with 10s, languishing around that 3.5% mark, not really doing anything. So this dollar move looks like it's a bit out on its own. I don't know why. It could be that we've over the Fed hump now, and like Kay said, we're getting into the year-end stuff, the end of month stuff, all that sort of thing. It could be pure risk off with stocks dipping and everyone's rushing to the dollar again. But I don't see what's happening today in the dollar as being part of what's happened with the Fed, in my own personal opinion. Because if we were trading the Fed, yields would be going higher with this move in the dollar and probably leading it. And I was speaking about this coming into the Fed and everything, about taking a snapshot of this time and after the meetings, and particularly on Friday maybe, of where markets are. We know what the Fed is doing. We knew what the Fed was going to do pretty much going in. We knew they were going to hike the dots. We knew they were probably going to go 50. We knew they were going to talk about keeping rates higher for longer. We didn't really get anything we didn't already know. and that's been reflected in the pricing. And the market is still pushing the fact that the Fed isn't going to get as high as it thinks it's going to get, and that is the main theme that I'm taking with me into 2023. Whatever happens between now and the end of the year, it can do what it wants. We'll trade it as we see fit. But from the fundamental and longer term perspective of what the Fed's going to do over the next 3, 6, 9 months, I'm taking it that the Fed are where they are at with hikes, and the market is seeing something different. And that's going to be the basis for how I have been and how I will continue to trade it. Just looking at a couple of questions there before we move on. Michael was asking, with a 50 BP hike by the BOE pretty much priced in, and with all the risk off mood, strong dollar, would you think we can get a tailwind for cable short, or is it too naive of me? I wouldn't say it's naive, mate. I think the BOE, as we've been saying all week, is potentially going to be a real big mess because we get these vote numbers. So we're expecting a hike of 50 basis points. That hike is expected to be 9-0 vote in favour, so no votes for unchanged and no votes for cuts. So there's always a risk there that we get something a bit dovish by maybe someone voting for unchanged or even a cut. I don't think we're going to get any cuts, but maybe someone thinks there's going to be an unchanged. That would be a negative for the pound. But then understanding how all the members voted, whether they voted for 50s, 75s, 25s, whatever, there is a big risk that there's a broad difference between those opinions. You know, if you get 8 of the 9 voting for a 50 pip hike and 1 votes for a 25, okay, that doesn't sound that dovish. But if you get only 5 people voting for a 50 and 4 vote or 3 vote for 25 and 1 voted for a 0 or 1 voted for a 75, it's going to bring a lot of confusion into what actually is going to happen with a BOE moving forward. Does it mean they're going to get hawkish, dovish, neutral, what? And I think that uncertainty is the big risk for trading this one. So until we know exactly what's going on, I certainly am not looking to trade cable. It's going to be a dangerous one to trade, particularly with what's going on in the dollar right now. If I had to pick one way to look at it, we know the dollar's strong today. If you get something from the Bank of England that sends cable higher, you've got to ask the question then, is it going to keep its gains, or is it going to carry on joining in with the rest of the dollar move that's broadly happening? So keep an eye on what's happening in the dollar against all the other pairs like Aussie dollar, Euro dollar. If you see them moving to new lows while cables, you know, hitting highs, and the trend's continuing for this strong dollar today, then maybe you've got a fade on your hands because the Fed and what's going on is going to outweigh what the Bank of England have done. But it is going to be a big mess. I'm not inclined to trade it. I know Kay's certainly not inclined to trade it as well. You got any additional thoughts for the BOE today, mate? Either of you guys?
Me? Yeah, I've got a thought. Stay away from it. No, really. As we've been saying since the start of the week, to me it's the most how shall I say, unpredictable. And even the reaction of the market to it is completely unpredictable to me. If you look, for instance, at Euro Sterling, it's been pegged around 86 for, what is it now, a week or over a week. So I think there may be some interest around this level, perhaps options also. But so cable and Euro dollar really have been moving together. After both ECB and BOE, I expect somewhere to them to start to drift apart, but I have absolutely no clue in how the market will react to what BOE has to say. And as we've also been saying, and as I've been saying, is that we have various possible comments and possibilities here that the BOE will talk about. They may talk about the hardship. They always like to err on the dovish or cautious side, as we've seen. Usually Bailey is rather on the dovish side. Is specifically and especially on the messy side. It's actually a shame we don't have a BOE press conference, a Bailey press conference afterwards. Otherwise, it would be easy. You just sell sterling and close your eyes and buy it back once Bailey is done. But no, it's really it's the unreliable central bank meeting, I think. So the only thing I did is that just in case they really make a mess of it, I bought some downside. But that's even over the turn of the year. So that's not even. I just found the level starting to be interesting, so I bought some downside. But no, for the rest, no. I'm not even planning to trade anything post BOE.
No, thanks, mate. Thanks. I hope that answers your question there, Michael. Catherine saying that cost of borrowing money will not go down for the foreseeable future, and all the zombie companies doing business may not last. Markets will sell off hard, possibly before Christmas. That is a question indeed. I can't see anything happening this side of Christmas. It's only a week away. I can't see the 100 million companies going bust that quickly, but it's definitely something. I still feel that rate hikes are still not being fully felt in the market. It takes a good, 3, 6, maybe longer months before you really see what rate hikes are doing. You can see moving faster in things like mortgage data. Obviously, we saw, if you follow the NBA, we saw the mortgage rate, 30-year mortgage rate, rocketing all the way up to the 7s. Now it's been drifting off to the 6s, low 6s. It plays into this financial conditions thing that we've been speaking about. If the market is not seeing the Fed going as high as the Fed say they might do, then the whole world prices a lower rate for their businesses. So mortgages don't need to be shooting up to 7%. It has the effect of artificially easing for the Fed because they're not as hawkish in their pricing for their products. And that's why Powell mentioned it, that they are watching financial conditions. But yes, if financial conditions do tighten more and more, that puts pressure on firms with borrowing costs and stuff. If they don't, it's a little less pressure. It's still pressure, but a little less. But in answer to your question, Catherine, that could be something we'd be watching into the new year. Okay, so ECB as well. Lots going on. What are we expecting from the ECB? Again, I think there's a bit of a risk that they might go a bigger hike. Otherwise, we're looking at a 50 pip hike across the board. We know where the risk is. If they do go bigger, that'll be the bigger price risk. Lagarde has been more hawkish of late, so I'm expecting her to stick to those sort of lines. The ECB projections, which sources touted, may be going up above 2%, their magic 2% line for the more longer term, could be a big effect that's spoken about by Lagarde. So I'm going to expect her to maintain her hawkish slant. Doesn't mean she's going to start rolling out possibilities of 100 pip hikes or anything like that, but the continuation of doing what they need to do to get inflation under control is going to continue. For the euro, again, it's a case of what are we doing before we go into the meeting? We're going in with dollar strength, so euro on the slide. From here, if we get back under 106, we're potentially going back into the box and then maybe down to 105s pretty soon after. But if they are reasonably hawkish and we get a move up, 107's been our marker for the Fed. That's going to be our marker for the ECB. If we hold there and the dollar remains strong elsewhere, I'm potentially going to be thinking about a fade to see if it catches up with what's going on in the wider dollar market there. But as far as I'm concerned, it's going to be a 50 as likely, small risk of a 75, and Lagarde to carry on the message she has been. Guys, your thoughts as well, please.
Well, on the euro, on the ECB?
Anything you like, mate.
Bank of England, as far as I'm concerned, I've been following them for years. Remember, I used to be a market maker in sterling rates. They will always take the opportunity to be dovish. So I don't think that's going to change. Today, we're pricing somewhere between, most likely 50, but there is a small chance of 75, right? I think 50 is going to be the one, and I think going forward they're going to take advantage of other central banks kind of reducing their pace to do the same. So overall, if in doubt, be dovish when it comes to the Bank of England. In my opinion, it's been working for decades, and the ECB is a different story. The ECB has been lagging in terms of inflation. Remember, the inflation started jumping in the US earlier. And the US is turning first. The Eurozone inflation is looking like it's going to be turning as well, but it hasn't. Again, it lags. So I'm a little bit confused, not confused, but I'm not as certain about what the ECB is going to do. But again, Lagarde has been dovish as well on pretty much every occasion, or almost every occasion. So I think this is a theme of pretty much all central banks going forward now. Things are turning, and they're going to be more dovish going forward, and they're going to be decreasing the pace of rate hikes. I think we're all going to be going to 25s very, very soon. I think the FOMC is going to be doing 25 next, and the Bank of England and the ECB and everything. So after today, I mean, so central banks, they're looking for reasons to be dovish almost always, and I expect that to continue. So that's my 2 cents, probably worth 1 cent, but that's what I think.
Cool, mate. Oh, and Kay, ECB, mate.
Yeah, I think the possibility for a slightly more hawkish statement, or I wouldn't call Lagarde, but this a possibility that they come over slightly more hawkish than what the market may expect or what they usually do. So that's a possibility. This time, if not, then I think all those euro crosses that we've seen rallying over the past couple of weeks are going to be coming off quite sharply again. And the possibility for them to be hawkish is to perhaps signal. So 50 is baked in, yeah. So to renew the 50 the next time, if they stay completely vague, that's going to take away that hawkishness, and then the kicker may be what they decide to do with QE, the asset purchasing program. Are they going to up the ante because the Fed hasn't signaled anything for a slowdown there, or not even talked about it, to be honest, yesterday? I wasn't even mentioned QT, if I recall well, on the press conference.
No.
So could they be slightly more hawkish there, and then we continue to I think, especially on the euro crosses, to go higher a bit. But it's a bit open. What I've noticed is that most of the time, you see one reaction and then the opposite reaction a bit later in the currencies when the central bank results come out. So we may find exactly the same case here, and have like a bit of a wonky market this afternoon, and then things settle down later. But I usually am relatively bearish, bearish euro, or how shall I say, cautious to be long euros. But as people know in the room, I've been playing actually euro crosses a bit from the long side lately into the ECB, because there is this possibility that they are a bit more hawkish compared to the other central banks. Let's put it that way. So that is one possibility I take into account. But for trading it, yeah, I've let these euro crosses go just in case they give me a better entry for some selective pairs perhaps later on. But I mean, it's inconclusive. It's less clear, I think, the ECB as well this time.
Yeah, and it's important for this one as well, particularly if you're trading it. If there is a big headline or a big announcement or a big comment from the guard that moves the market, you've got to be careful of that move, because it can suck you into a false sense of security. Let's say the price jumps 50 pips on a comment and doesn't do anything after. That's sometimes the market just waiting to the end of the presser. So in case they're going to get a counter comment that sends that 50 pips all the way back down again. So what you can get is a second wind when she's finished. If she said something that's changing something in the market may move, it then may pause. Don't think that's going to be a top or a bottom. Wait to the end of the presser, because you can get a second wind and it can carry on thereafter. That sort of thing is always happens with, particularly with the ECB. You can get that second wind move. Dollar CAD is another one over the BOC for second wins. So be careful of that, effective trading it. But yeah, for me, I'm really not looking to put on anything major new, apart from sort of scalping whatever levels show up at the time. You know, I was coming into the beginning of this week looking at you know, my Aussie dollar positions, thinking we had this nice big move up, got, you know, on the CPI. Looks like it was breaking 68. Now we're well below again. If we close the week below 68, then this has got a whole lot of work to do again going into 2023. If we can close back above it, it's going to look fairly bullish for me. But this was my worry, that we finished the week not up here above 68, but down below. And at the moment, it's not looking too good. We're moving through the supports, moving through this minor trend line here, just showing the trend. If we can't hold this, maybe we're going to have a look back down at this 66, 60, 80 area once again. That may be where the lines get drawn in the sand. But we're going into year end. For me, all bets are off. I've seen some strange moves. I've seen some big moves that come out of nowhere. So we've pretty much undone the CPI rally at the moment. And what has really changed? Not a lot. CPI is where it is. The Fed's where it is. And we've just been on a nice little mooch around the levels. The same goes for other pairs. Dollar yen, I added a little bit. I've got a bit of a short still from 136.66 that I had on the other day that I took some profit on. I did add last night a bit more, keeping it very small though, in the 135s. If this dollar move is going to continue and we're going to get some craziness, fine. If we get up to 138s, 139s, maybe even 140s, I'm going to keep tacking on a little bits of shorts onto my position, see if I can build up a bit of a bigger position going into 2023. So that's my view pretty much of how I'm going to trade things today. Tomorrow's going to be a bit of a write-off. Me, the K-Man, and a couple of others are going to meet up for lunch. So we're going to be doing a flow show and then buggering off. So I'm not going to be doing much trading tomorrow. But there's plenty to be done today. So we're going to keep an eye on the levels. Kay, do you want to have a look at anything in particular, or Stel? I don't think we've seen any of your charts this week.
Yeah, I can have a look, but if Stelios wants to show something, I'm open to anything. I just wanted to, Stelios, do you want to show stuff?
I'll. How about I do that tomorrow? What do you think? After Bank of England, after ECB, after everything.
Yeah, fine, mate.
Yeah. So you show whatever you have to Cayman today, and I'll do that tomorrow.
Fine. It's just that I'm going to have to jump a little early, so you can take your time. Okay, I'm ready.
Okay, let me kick the ball over.
First of all, I've seen a question here.
Where am I going?
Rob.
Hang on, can't be button. There you go.
Thank you. All right. First, I take Rob's question. Why? I mean, any comment on 15.64? That's quite precise, actually. Move in the Kiwi CAD. Well, there's been two things, right? What have we seen over the month of November, and a bit before, perhaps that as well. There's been some development. And if you look at the November move in this, right, and then you go back to, and you can virtually overlay any CAT chart in this, and then you look at the November move in a pair like a CAT pair. So okay, Kiwi CAT has gone very far because Kiwi has been underpinned by various good data. They were less affected by everything, a bit far from my bed, safe haven as I call them. And we've also seen gas prices coming off. So there's been a lot of stuff playing for Kiwi over the past month, and against the CAT. And now, if you look at this, we are trying to break out of this channel, right? So things may look a little less positive for the Kiwi, and that's also something that I'm trying to trade, not specifically in the Kiwi CAT, but in other pairs. So I think this move could be or has run on its last legs, but and because we've been tagging earlier levels, and as we can see, we just undone the whole move from March into October has been undone in 1 month. So the explanation on the fundamental side is relatively simple, I would say. Now, I had another one here. Yeah, this one. So this I'm playing or trying at least to play this break. I'm cautious now against the ahead of the ECB. So I've let most of it go. Actually, everything go for now in the Euro Kiwi. But if ECB gives me an opportunity to get back in towards mid 165, I'll likely take this opportunity in the Euro Kiwi, because I think there's stuff changing for the Kiwi. And that's actually another question on the strong Kiwi data. They were stronger than what was expected, or indeed. But don't forget, Charlie, those are Q3 data, and we are nearly at the end of Q4. In between, we've already had quite a bit of other news and expectations that this higher trend in New Zealand data is about to reverse. There's also quite a few issues going on in Kiwiland right now. So I'm not excluding a kind of a Christmas hold for the Kiwi, but I'm starting to think Kiwi has perhaps ran as far as it can for the time being. Of course, price action will show us. But if you also look at the Kiwi dollar, for instance, we are starting to break back supports. Of course, the dollar is a driver, but we're starting to break a few technical supports as well. Keep an eye on this level actually here in the Kiwi dollar for this afternoon. But I wouldn't exclude a move back into the lower end of the 63s. Also, the other pair, this one, the Aussie Kiwi. I think we've, as I've been saying in the room as well, I've got the impression we have traded the divergence between RBA and RBNZ enough. I'm actually relatively surprised that we are hanging low here. Still only, well, we're back actually below this longer end trend line, and we for sure have not been able to break this 106.60 yet. I thought we would be a little higher already today because of those very nice Australian employment data. So this is one which is firmly on my radar. I think there's a big support zone here, anywhere between 105.25 and 105.5. This is one that I'm looking at. And then Oh yeah, I had a special request from Michael in our room on the Euromex. And Euromex is really, as I was already saying yesterday in our room as well, this is firmly on my radar now because we have the combination of the ECB and the Banxico today, and this could really be on the move after this. So the uncertainty around the ECB is telling me to still be cautious, but we are getting into levels around this 21.10 to 21 and a quarter, which could be very interesting for this pair. Banxico is the other risk because they've already said that they may start to slow down, and since the Fed slowed down, they may slow down as well this evening and give a hint at further slowdown. So for the time being, I'm still being very cautious on this one. But if I get the confirmation today, and hopefully we are going to test this 21.10, 21.25 zone. If I get the confirmation that it's a top because it's also been a traffic zone in the past, I'm going to start to leg into this one again. But I really want to see what both central banks have to tell me today. If we're starting to get below, let's say 85.90 and get a close below there, I think the party may be over, especially if we confirm back through 2070 where the 200 DMA lies. I think then we could be starting a fresh leg lower. But I really want to look at the combination of both. Yeah, as already shown, not this one. Ryan spoke about on the daily about this 38.2. Where is it? This one, 38.2 at 68.75 on the Aussie. There was this the 200 DMA, which is still hanging around 69 the figure. And if we look closer, I showed a few trend lines, a few channels, and this really capped yesterday post FOMC. And now this zone is going to be really tough, I think, in the Aussie. It's going to need some really good Aussie data to break this one, in my opinion. So the risk for me is that we are at least going for a little retest of the channel here at 67.15, depending on how the US trades the dollar this afternoon. Kiwi already shown it. We are in a bit of a similar pattern there. The metals then, that's been quite a big slap overnight, and I think the reason for the slap, especially in silver, gold went the same way. But I think one of the reasons for this slap is the weak data out of China. Since silver especially is an industrial metal, it's a bit of an uncertainty what's going to happen with it here. To me, as people know, I sold a little bit of my long terms out around this level, and I've been trying to be patient. I'm lurking at it. I'd love to see at least a retest of 22.75 in silver. Why not even low 22s to start to leg in again? Hopefully, the US is going to give it to me later, so I can re-enter again, because my long-term view hasn't changed. I still want to be long of these. Gold, broken out this trend or channel or wedge, how you want to call it. We're still not that far. It's around 1785, but at least we're in the bigger picture back below 1800. There's a possibility to get to go and test 1760-65, depending on what the states want to do with their dollar this afternoon. And what else? I think somebody was dollar yen. Yeah, I want to show the dollar yen. So I had this trend line on for a little while. So yesterday, very hesitant around there, and then this morning it decided to tackle it back above 135.55, 65, and we had a big run up. And that, despite the yields not moving much. So perhaps the people were waiting exactly for the Fed to be over to see what was happening. And we also had a very negative trade balance over there. And we know that Japan needs to run positive trade balances to give the yen a chance to really keep the strong bias. With the jump in exports and imports is a year-on-year number, and we know last year that Japan was virtually on its knees. So compared to last year data, and as Ryan already mentioned, looking at the difference in value of the yen, those numbers were much higher, but I would shrug them off personally. So for me, have a look at what's happening around 137. If we get there, 90 figure dollar yen, and if that breaks later on today, why not have a revisit of those of this 137.90 figure, which is really the level right now to me. If dollar yen continues to go higher, to watch out for. If 138 goes, then there's a risk we are going back to 140 perhaps. I'm not going to spend much more time. Euro yen quickie, it's broken here, been on the long side of it. Now erring on the cautious side of it because we haven't broken yet above the prior high. But if we start to tackle 145, 50, 65, I think this could have a bit more legs. Got a fragile trend line coming in around 150, 46 and a quarter, but that if the ECB is hawkish, might not be enough. But we will see on the ECB. Anyway, in any case, if we see move back lower, to me, it has to hold around 144 and a half to keep on going. And that is about it for me, Ryan. Unless somebody wants to have a look on something else. Oh, dollar Noki, yes, one of my favorites as well. Yeah, so people know in the room that I've been a bit long on this. I've let it go after the Norges Bank. Also had a nice spike, and it came close to a bit of resistance here. But my main bias is still to be long of this for as long as we hold 970. If this gives back, or if it gives way below 970, I think it's bad news for the dollar Norway. Okay, and keep a close eye on the oils, Brent, as well, because it's going to be a factor, especially into the year end, because there still might be some companies needing some Norwegian kroner for the tax payments. But on the other hand, Norges Bank is selling Norwegian kroner every day. So to me, that keeps me still in the more bullish camp on the dollar Norway for as long as we hold really the 979. I think over time, or perhaps into year end, if the dollar keeps well, right, we can get perhaps back a bit closer to the 10 level. And that is it for me, Mr. Ryan.
Thank you very much, sir. Kate, just before we finish off, it's worth noting that we have got a huge chunk of data coming out from the US today as well. Jobless claims, Empire State, which is the first look at the manufacturing data for the month. I don't know what my page
Philly
is.
Fed, retail sales,
Philly Fed as well.
Industrial production
later. Yeah. So there's plenty of data coming out just before Lagarde starts her presser. We'll obviously know the details of the announcement, but then she has her presser 15 minutes later than all this data. So keep an eye on that. The data could be a big switcheroonie for the dollar. What we're seeing today, what that data comes out as. So keep an eye on that there. And just to finish off, as always,
3 p.m., Brian.
What's that, mate?
I see you at 3 p.m. I'm taking 3 hours off and come back when the dust settles.
Yeah. So yeah, I didn't share my screen again. There you go. There's all the data that's coming up. Empire, Philly, jobless, you name it, retail sales, all in the mix there. Again, just to before we close off, don't forget we are running our traders funding program. I've dropped a little link in there. If you want to upscale your trading, trade our money, come and have a look at that. You need to pass the assessment. There's different sizes of accounts from 25,000 up to 1 million. Check the details out on that link there. And also, if you want to come and join us in the chat room, a good time to do so with all these Fed meetings going on. You can do so there. Come via this link at forexflow.live and you can take the 20% discount, that exclusive discount that we have on offer there too. And so until tomorrow, good people, enjoy your day, stay safe over the Bank of England and ECB and all the rest of it, and we'll find out what's happened tomorrow. Thank you very much, everyone. Trade safe. Thank you, Stel. Thank you, Kay.
Thank you. Take care.